First, we want to address the difference between an audit and the agreed upon procedures. An audit is an objective examination of financial statements to provide an opinion on whether these statements are stated in accordance with established accounting standards and whether they are free of material errors or other misrepresentations. An audit would not have answered the key questions and allegations that have landed Mystic Lands in this state of damaging discord. An audit of the POA books could not have included a non-POA bank account, the account at the center of most of the financial allegations. Now, the goal of an agreed-upon procedures engagement is to perform specific procedures designed to address specific issues of concern, using the standards for accounting and review services issued by the AICPA. No opinion is offered by the CPA. Instead, the CPA presents factual findings from which one draws self-evident conclusions. In our case, the audit product is not a greater effort than an AUP. It is an entirely different product. The AUP tested a larger population of transactions than would have been tested in a traditional audit. The multi-year scope of the AUP is a deeper and more exhaustive dive into record keeping than a traditional audit. Under these circumstances, an audit would be a waste of the POA resources. The scope of the source data utilized leaves no stone unturned. Two sets of accounting books, one from the POA and the other from litigant Fred Yates. All of the developers' accounting records requested were provided. Bank statements and checks, invoices, timesheets, county records, tax returns and other state and federal filings, board minutes. With all the documents in hand, these are the steps taken by the CPA to accomplish her task. Review of receipts and disbursements. Test calculations of detailed financial records obtained from source data, bank statements, original vendor invoices, etc. Cross-referencing of original source data, bank statements, canceled checks, vendor invoices, and timesheets with the POA QuickBooks data. Conferences with AMI, the declarant and current POA president. Conference with Greg Deal, the former executive director of the POA. Conference with Barbara Rich, a former POA bookkeeper. After completing her investigation, in an effort of complete transparency, the CPA held an exit conference with the attorney representing the litigants, the attorney representing AMI, the attorney representing the POA, and a representative of the POA board. After presenting her findings, the CPA asked if anyone had any additional information for her to consider before writing her final report. None was offered. We are eager, of course, for you to watch this presentation in its entirety. In summary, the AUP work delivered a management letter. It contained findings of shortcomings in the Mystic Lands POA management of record keeping and the implementation of internal controls. However, it found no financial wrongdoings by AMI or the POA board. AMI did not steal any money. The report tells us of work done and challenges encountered. The AUP report is based on original documents, payroll records, bank statements, checks, and invoices. It is based on tested facts, not mere allegations, suppositions, or theories. The CPA requested the litigants' evidence in support of their allegations. She did receive significant discussion, comments, and opinions, but received little documentation from them in support of their arguments. The CPA asked Greg Deal and the litigants to provide documentation to support the allegations made by the litigants. She also met with Greg in a lengthy private conference. Greg provided extensive details of the allegations. When asked to provide documentation to support his position and the allegations, he stated that his attorney did not permit him to provide documentation at that time, apart from copies of documents that, on review with all financial data, represented only part of the full transaction picture. The following represents the context for our summary presentation today. For greater latitude of expression, the POA Board prepared this summary, focusing first on the financial allegations and setting them in a broader context for better understanding. Thus, it provides further affirmation of the report's factual findings. The reason is that the CPA is restricted in her language in an AUP engagement, as her work does not permit the expression of an opinion, only findings of fact. Furthermore, the historical, technical, and detailed nature of the AUP report may present a challenge to an uninformed reader. This summary presentation and the final report will be posted on our POA website. The first allegation relates to the septic system at the Meadow. The allegation reads, Mr. Sinitsky directed the association staff to deposit checks made out to the association for dues and special assessments to another account owned by Mystic Lands River, Inc. Now here are the relevant facts for better understanding of this allegation. Owners at the Meadow section of Mystic River decided to build a joint septic system rather than individual ones and formed the Meadow Partnership. Until formed as a legal entity, the Meadow owners could not open a bank account to deposit their money and fund their project. AMI offered the Meadow owners use of a dormant bank account that had belonged to Mystic River, Inc. to use as the partnership operating account. Mystic River, Inc. was no longer active. It had merged with Mystic Lands, Inc. The bank account, therefore, was no longer being used. This bank account was neither a POA nor a developer account. The account was managed solely by the POA office, Greg and his significant other, Michelle. Account records were kept at the POA office, not with AMI. The POA office handled the check deposits, bill payments, and bank reconciliations. This non-POA bank account, managed independently and conveniently at the POA office, was also used for the water system project. The water system project, separate from the septic system, consisted of Ridge and Forest community wells. The project was managed by Greg under separate contract with the developer. Here is a demonstration of how inadvertent instructions led to the misplaced allegation against AMI. Take a moment to review this email. In this email, there is an incorrect instruction to the partners to make their checks payable to the POA. Clearly, these funds were intended for the partnership, not the POA. Despite the incorrect instructions, checks were deposited in the Meadow Partnership's operating account, where they were intended. Related to the Meadow septic allegations is the Ridge and Forest water system allegation. The allegation reads, Mr. Shinitsky directed the POA Association office staff to deposit all checks received from lot owners for an assessment for a community water system into a bank account owned by Mystic Lands, Inc., and used approximately $60,000 of the funds to improve lots owned by him or one of his companies. Breaking down the allegation, here is the gist of the allegation. The community water system was a POA project. The water system was funded by POA assessments. POA funds were deposited in a developer account. $60,000 of the water system POA funds were stolen by the developer. These are the allegations. Here is a copy of an email from Greg Deal, clearly telling owners that the water project is not a POA project, but one initiated by the developer. Please take a moment to review this email. Contrary to the allegation, the water system was not a POA project or initiative. The project was clearly initiated by the developer, Mystic Lands, Inc. In his next email, Greg not only acknowledges that this is a Mystic Lands developer project, but instructs owners to make their checks payable to Mystic Lands. Please review this slide. In this email, explicit instructions are provided by Greg Deal that checks are to be made out to Mystic Lands, Inc. and not to the POA. Therefore, this was not a POA assessment. In this final document, you can see the terms of the conveyance of the water system from the developer to the POA. It says it all. In particular, the paragraph which reads, "The water systems at completion include electric service, wells, pumps, pipes, taps, and miscellaneous plumbing. All remaining costs to render the systems operational shall be Mystic Lands, Inc.'s responsibility." Also note that as of the total number of potential participants, only 11 owners had not subscribed as of this date. Prior to November 1st, 2012, the POA did not own the water system and would have no reason or legal right to levy an assessment. As of this date, only 11 lots were still eligible for the $5,000 buy-in rate. This totals $55,000, of which only $50,000 was collected. Since Mystic Lands, Inc., the developer, assumed full responsibility for the total system cost, these fees were contractually due Mystic Lands, Inc. The following observations are inescapable. Since the bank account at issue is not a POA account, the POA has no legal standing with respect to this account. How then the allegations? AMI could not steal money from his own account.
Hypothetically, even if the funds were raised through assessments and not contractually due to the developer, then stolen from the POA, it would not be possible to steal $60,000 when only $50,000 was collected. Hypothetically, even if any funds were improperly removed by the developer, it would make no difference, since Mystic Lands Inc., the developer, is contractually bound to fully complete the water system, regardless of the cost. The cost of this project has already exceeded the budget.
Now, again from the AUP report, about the water and septic systems bank account. All transactions were recorded and reconciled directly from actual bank statements, not copies, into a record-keeping package of receipts and disbursements. The amounts contributed to the account by the declarant and the amounts withdrawn from the same account by the declarant are essentially the same. No money was taken from either project by AMI. All deposits made by the partners to the two systems were used for partnership purposes. No funds were misappropriated. No funds deposited into the account were POA funds.
The next allegation is the developer stole $35,852 from the POA. The allegation reads thus. Mr. Shinitsky instructed the association staff to sign over to Mystic Lands Inc. a check in the amount of $35,852.71 payable to the association for dues, tap fees, and assessments on a lot that had been foreclosed on by Fifth Third Bank. And here is the background factual information. As the December 31st, 2013 email shows, Greg Deal hoped to purchase this lot and resell it for a quick profit. In his position as executive director, Greg was in the unique position to know of lots in distress, and he used this insider information on several occasions to his benefit. In the hope that Fifth Third Bank would absorb various POA charges, Greg issued an invoice in the total amount of $35,852.71, which included a fraudulent charge of $32,000 for a septic hookup. The bank rejected the invoice, demanding that the buyer pay these charges. When AMI entered as a prospective buyer, the fraudulent POA invoice could not be retracted without putting the POA in a bad light. In fact, the POA invoice included in the closing statement is for a different amount than is stated in the allegation. It was changed to $33,923.05 after Greg realized that he could not charge for unpaid dues. This entire amount was added to the purchase price of the lot and paid by AMI. Of this sum, only $1,423.05 was due to POA. AMI repaid himself only the amount he paid the bank in excess of the sum rightfully due to POA.
Now here are a couple of documents that shed light on Greg's mindset and actions. Take a moment to read each of them, and we will examine them more closely. Dance of responsibility. What Greg really means is, will the bank accept this claim of assessment as part of the purchase price? Every unethical tactic seems to be permissible to Greg. The $32,000 figure given to the bank was untrue and unauthorized as an assessment by the POA board. It had nothing to do with the facts. As this email shows, there are advantages to having insider information.
next document speaks for itself. It is the invoice that Greg created for Fifth Third Bank, in which he included the unauthorized charge for septic hookup. That was in fact a Meadowship partnership project. Stating special assessment pursuant to paragraph 405 in Mystic Forest Declaration of Covenants Construction of Community Sewer Plant. But in fact, the sewage plant is owned by the Meadow Partnership, not the POA. The POA therefore has no legal standing to levy an assessment. Only the POA board can levy an assessment, and it never did. Even if an assessment were possible, it would be a specific, not a special assessment. It could not be in the river if pursuant to Mystic Forest covenants.
Now, again, from the AUP report. The declarant provided documentation that he paid the fees on closing to the bank from personal funds to protect the integrity of the POA. On closing the property, the bank remitted the charges to the POA. The declarant was entitled to reimburse himself $32,000 and the $500 water fee due to him of the $33,943.05 he had paid on closing. The CPA asked Greg Deal specifically about the nature of these fees. Greg explained that the invoice reflected normal fees, including fees for water and sewer that were normally charged by the POA and, therefore, due from the declarant when he purchased the property. No other homeowner fee of this size collected by any of the POAs was observed. This type of fee could not be located in record keeping as a normal charge.
The next allegation addresses the payment for former property manager Robert Cooperrider. The allegation reads, Mr. Shinitsky used association funds to pay Robert Cooperrider for work on behalf of his companies unrelated to the association's management. Cooperrider was the property manager for the 3 POAs from late 2007 to mid-2009. Coop also had responsibilities for the developer, who, contrary to the allegation, did pay 50% of Mr. Cooperrider's salary. Again, from the AUP report, 1/2 of Cooperrider's salary was paid by Mystic Lands Inc., the developer. In 2007, 2008, and 2009, Robert Cooperrider was paid from POA funds. Invoices were created from the POA to the declarant for 1/2 of Mr. Cooperrider's compensation. The AUP included tests for 2008. The CPA examined declarant charges and POA receipts of 1/2 of Mr. Cooperrider's compensation from the developer in record keeping and the POA operating account. The next allegation is the POA's debt to the declarant, and it reads, Mr. Shinitsky claims that the association incurred indebtedness in the amount of $280,000 to him without knowledge or approval by the board and seeks payment of that amount. A few background facts on the POA's debt to the declarant. The long-term debt shown on the POA balance sheet at the time that this allegation was made is for the amount of $263,273, not $280,000. Why not be accurate? Contrary to the allegation, the board did know and approve, although not by a motion, the declarant's advance funds. This is pursuant to the covenants to make up budgetary shortfalls. Contrary to the allegation, the declarant has not made claim of payment of that amount. Contrary to allegations that the declarant claims the debt, hid the debt, announced it in September 2014, or by Executive Director Greg Deal that I only found out in June, the debt is recorded in the POA books since inception in November 2006.
As to transparency, the accounting books have never been kept by the declarant, AMI. They are at the POA office and were under the supervision of Greg Deal, former executive director, and Michelle Hedden, the POA bookkeeper, who is a related party to Mr. Deal, putting the POA in segregation of duties jeopardy as to adequate internal controls. Declarant had no obligation to assist the POA in addressing the shortfalls. Furthermore, what possible motive would there be to conceal his generous assistance to the POA, interest-free?
And here is a relevant section from Mystic Lands Covenants. See Article 4, Assessments. Declarant shall not be liable for the payment of any assessment or be required to make any contribution to make up an association budgetary shortfall. During said period, however, declarant may advance funds to the association to satisfy the deficit between the actual operating expenses of the association and the sum of annual, special, and specific assessments collected by the association in any assessment year. Contrary to the allegation that the declarant concealed his advancement to the POA, bookkeeping records going back to inception tell us exactly the opposite. To fully examine this issue, the following procedures were performed by the CPA firm in relation to debt owed the declarant. All correcting journal entries were eliminated from the analysis, retaining only those entering specific declarant invoices. Journal entries identified as duplications of invoice, payment, or cash transactions were eliminated. To address the risk that not all cash transactions were classified properly into the current liability accounts, cash receipts and disbursements from all sets of record keeping were exported. All these schedules were then reconciled. And furthermore, the following procedures were performed by the CPA in relation to cash transactions. Cash deposits and cash transfers were traced directly into POA bank statements for each of the POA bank accounts, separate and combined. The bank statement account number and description for cash transactions totaled $87,800, representing 63.96% of the total transfers were examined. Conclusion. We determined that the current liability to the declarant is approximately $256,446.
The next issue is integrity of the POA books. The objective of the procedure is to calculate the expected results of operation for the consolidated POA. POA QuickBooks financial records were provided to the CPA by litigant Fred Yates. The CPA also obtained a backup of QuickBooks on site in the POA office. From these two sets of financial records, the CPA created schedules of revenue, expenses, and payroll costs. A recalculation of excess of expenses over collected dues was prepared, as if the three POAs had been combined from the beginning as one master POA. Dues and assessments were recalculated from the recorded purchase dates of the lots. Payroll costs were recalculated directly from timesheets and payroll reports. Vendor payments were recalculated directly from the invoices.
From the AUP report, here are observations and results. Internal controls need to be improved. The testing of employee timesheets for 2012 and 2013 revealed that total hours did not match the payroll records, were not reviewed, were not clerically checked, and were not properly authorized by the Executive Director, Greg Deal. The calculation of POA expenses in excess of collected dues for the POA and Yates copies are precisely the same. The CPA recalculation is materially the same. The CPA difference increases expenses over collected dues by approximately 3.5% and is explained by errors found in the preparation of bank reconciliations. Our next topic is the value of amenity and common area assets conveyed to the POA. Here they are. Highlights of the AUP procedures. Reconciliation of the two copies of the record-keeping data, one provided by litigant Fred Yates and the other by the POA. Obtained a schedule from the developer of $5,460,170 total cost of property conveyed to the POA from the developer. Examined supporting documentation of 64.39% of these costs without exceptions. The above percentages include examination of invoices of developer costs to construct the POA property conveyed and scheduled. And again, referring to the AUP report for its observations and results. Utilizing the declarant's actual cost basis and not including the cost of financing, the value, cost of the amenities and common area assets that Mystic Lands POA and its property owners have received from the declarant, AMI, is approximately $5,460,170.
The following are allegations which are not included in the AUP report, and they read, Mr. Sinitsky waived interest on past due amounts owed to the POA by members of the board and officers. Mr. Sinitsky used POA funds to pay for the cost of clearing building lots. Mr. Sinitsky hid the sale of Lot V23 to a partnership that includes two current members of the board in an attempt to avoid payment of dues since 2010. The first allegation is that interest was waived only to board members by AMI. In a September 19, 2014 email, Greg Deal wrote in part, "There is no mechanism available to waive interest under state or federal law, nor in our current covenants or bylaws. To my knowledge, no other member received the benefit of an interest reduction. To allow officers and directors a special privilege is a blatant act of discrimination."
Yet, here is Greg promising a ridge owner to find a way to remove the interest from their account. To protect the owner's privacy, their names have been redacted. And here's another, one more owner's interest waived at Greg's initiative. And yet still another. Yes, AMI gave the approval on this one, but this forest owner is not a board member. Finally, here is a partial list of forgiven owners routinely made at the office by the Executive Director, Greg Deal. At times in consultation with AMI, but not at AMI's initiative. Hardly the case as alleged that no other member received the benefit of interest reduction. The next allegation, POA funds were used to pay for clearing building lots. Here is a POA timesheet, which includes the provision to allocate costs to the developer. The Executive Director, Greg Deal, responsible to review and allocate work, failed to allocate work done for the developer or on hundreds of hours on his own lots. Developer has since been billed for hours worked on his behalf.
The last allegation addressed in this summary is that the sale of Lot V23 was hidden to avoid paying dues. The evidence refutes this allegation. A letter offering an investment share in this lot was sent to all owners. 2 of the litigants acknowledged it. 7 property owners signed out investors. 2 owners, one aligned with the litigants, and the other who financially contributed to the litigants' legal fund, are 2 of these 7 partners. On the Mystic Lands website, all developer lots are offered for sale, but V23 is not. The lot is shown sold on the Register of Deeds website. October 6, 2009, a letter offering investment share in Lot V23 was sent to all owners. It was hardly a secret. Litigant Tom Anderson inquired following the letter. And here is AMI's reply. Litigant Tom Schreiber, acknowledging the opportunity, politely declined to participate. How can it be alleged that AMI kept this a secret? Who is Elizabeth Keel Gomes? She has been an auditor since 1976. That is 39 years. She has been a governmental auditor. She continuously receives the top rating in her peer reviews. She is held in high esteem by colleagues and attorneys alike. She did not know or meet AMI until her first visit for fieldwork at Mystic Lands. She knew no one at Mystic Lands until contacted by the audit committee. She is required in her profession to consider and maintain independence in all SSARS engagements. She would never risk her standing for one fee, as has been alleged.
The following sequence of emails will give you further confidence as to why AUP and not an audit. To quote Marvin Beasley, "I have been an auditor for 40 years, and the content and wording of the engagement letter is critically important. I would hate for the POA to spend money on a process that would not result in a resolution of this conflict." Mystic Forge property owner and auditor for 40 years, Marvin Beasley, unknown to any board members or AMI, offered to weigh in. In the next email, having been sent a copy of the engagement letter from Ross Minot, who created the document, not AMI, Marvin Beasley wrote, "Ross, these procedures are exactly what I was recommending to AMI. A financial statement audit would most likely be a waste of time and money, while these agreed upon procedures are specific to the issues raised by some property owners. I support the board spending these funds to resolve the issues at hand." Longtime auditor Marvin Beasley unequivocally tells audit committee member Ross Minot that a traditional audit would be a waste of time and money. What's required to answer the troubling questions raised is an AUP, the scope of which Mr. Beasley had just reviewed. In the next email, Marvin, having been asked to speak with litigant CPA William Hanna, responded, "Ami, I have talked with Bill Hanna on Monday and asked that he review the scope of work proposed by Ms. Keel. He was going to review it and add any additional procedures he felt would be necessary." In the interest of transparency, litigant and CPA William Hanna was asked to contribute to the creation of the AUP document so that the litigant group would be satisfied that the process leaves no stone unturned. His final email was a surprise to the board, whereby Bill Hanna declined to participate in the creation of the scope of the AUP. He wrote, "I am concerned that as long as the declarant is willing to dismiss board members for disagreeing with him, that he will not hesitate to dismiss any board member for accepting any findings from a review of the books and records that may be detrimental to him. Therefore, I cannot in good conscience participate in this process at all." On the hypothetical scenario of what might happen if Ami did not like the report's findings, Bill Hanna declined to participate in the process that he knew would answer the pending questions and a report that would stand regardless of how Ami responded. Is it that it would be hard for the litigants to criticize a process of which they were a part?
While shortcomings in the POA management of record keeping and the implementation of internal controls were found, no financial wrongdoings by AMI or the POA board were found.